Good morning, everyone. I will try to give you a very brief overview, really, of how we see dry bulk market at the moment. I hope this is going to be a good introduction to our panelists, basically for their overview of the markets. Since dry bulk market basically crashed in January this year, there are two questions basically that we see occurring. First question is obviously, did we reach the bottom? Did we reach the rock bottom of the market? And the second thing is obviously, if that happened, obviously when we're going to see substantial recovery into the market. So I'll start basically with the overview of the commodities and how do we see basically the major commodities moving in this year and in next few years. There is some good news and there is some bad news, and our perception is obviously that for the major commodities like iron ore, we're probably going to see quite sustainable level of trade. Obviously, major country to look at the moment is China. Everyone is basically wondering what is going to happen with the Chinese economy. What is good and what goes for iron ore imports in China is obviously that exports basically from Australia and exports from Brazil are very high quality, and they are actually quite cheap to import. So we do expect basically for domestic iron ore production to basically go down, and we do expect seaborne trade to go up as a result of that. Obviously, that we don't expect massive growth. We do expect just about 1%. That is connected quite as much to basically current situation, the steel market in the Chinese economy. So obviously there is an overcapacity over there, and the recent announcements from Chinese government with the recent 5 years plan are saying basically that there is an intention for consolidation. Obviously tariffs and anti-dumping procedures are going to influence that, and the safety valve that they used through 2015 with this basically flooding market with lots of cheap steel and basically compensating for dropping demand in their current market, in their own market, basically may be under question in future. There is some good news for coal, and I say some good news obviously because we will probably not going to see the level of coal imports dropping in China like we've seen in the last couple of years. IHS McCluskey reckons that we're probably going to see a drop of about 3.6% this year in seaborne imports in China. We do expect obviously some occasional growth in South Korea because there is new power stations that are going online. We do expect to see some more imports into some other Asian countries, but nevertheless we don't expect to see much change into the coal market when it comes to the seaborne trade. In terms of grains, situations is still expected to remain very neutral. We do expect obviously some new entries from Argentina. Obviously the new policies coming out of Argentina are expected to have some positive effect on ton mile. We do expect quite a lot of grains to move from Argentinian markets towards Far East. Minor commodities been actually a bright star of 2015, and we do expect minor commodities to remain fairly strong to 2016. Majority of that was, however, supported by quite a lot of steel exports coming out of China, and that supported quite a lot of geared vessels, freight rates, particularly in the Handymax sector and Supramax sector. That remains under question with the recent tariffs introduction from the United States, Europe, but also talks about Indian tariffs as well. We do expect those rates to remain under pressure and those exports actually to slow down at some point. So what's been happening with the supply, with basically what's happening with the market itself? So we've seen actually quite a modest growth through 2015 in real terms, because we've seen quite a high level of demolitions. Just a little bit more than 30 million deadweight tons was removed from the market. And right now, what's standing on our order book is basically about 83 million to be delivered this year. However, even at the best of the years, we don't expect obviously the full order book to be delivered, and that's not going to happen in 2016 for sure. We seen about 30-35% of slippage and cancellation activity in last year. There is no reason to believe it's going to be less this year. We believe it's going to be just a little bit less than 50 million deadweight tons altogether delivered this year. There is some encouraging facts so far this year, although we are just only in one quarter. We've seen quite a high level of demolitions. If we put into perspective, last year we've seen 30 million deadweight tons altogether removed. So far this year, we've seen about 12 million deadweight tons removed, which is high level of demolition for sure. For some markets, for example, like Panamax and Capesizes, that was good news. For Panamax market, we see obviously negative growth so far this year. For Capesize market, we see almost neutralized growth by the demolitions. That's definitely good news for the market, and that's something that is definitely going to help to rebalance the market at some point. However, the question remains, how much is enough to rebalance the market? Discouraging fact is basically that we see quite young fleets. Recent demolitions in the last few years basically left fleets fairly modernized with quite a good vessels basically on the fleets. And we would expect some pressure basically on average age and some pressure basically on the fleets to, in terms of economical viability, economical lifeline. We see most potential still within the Panamax sector. There is just about 16% of ships of all capacity in Panamax sector is 15 years and older. We see about 13% basically of a Capesize sector that is 15 years and older, although these numbers, I must say, include quite a lot of conversions that happened basically prior to 2010. Ships basically converted from very large crude carriers to very large oil carriers, and we do expect these ships actually to be removed quite soon anyway. So, all in all, what do we expect? We don't expect, obviously, major moves to happen in 2016, although I'm sure panelists are going to give us different views from their place where they are sitting. Really, they can see it into more detail. But we don't see major movements in the market in 2016, given, obviously, the basics of supply and demand. What we expect to see is basically that 2017 is going to be a transition year. Again, we don't expect a huge level of improvements in 2017, and that is obviously based on the presumptions that we're going to have high levels of demolitions and quite high level basically of cancellations and movements into deliveries market. So we do expect basically to see just about 2.3–2.5% of additions this year into the supply. However, what is really bad for this year, we don't expect more than 0.5% basically of demand from the dry bulk side. We do expect that to turn around in 2017. We do expect to see just about 1.3% net growth of the fleet, and we do expect, hopefully, if obviously recent economic woes don't actually tend to be quite bad for the markets, we expect to see some growth in terms of the demand of the dry bulk market. So some people basically reckon that this is actually dawn of new era. Some people reckon that basically we are coming back to the prior to China entering WTO market, and basically it is the time to basically get used to some kind of more sustainable growth and not see basically any kind of a huge growth basically into market in the next few years. I hope this was quite a good brief overview for the panelists, and if you have any questions, please ask.
Thanks, Dalibor. My name is Omar Nokta. I'm with Clarksons Platou Securities, and I'm going to moderate this next panel. Thanks, Nick, for putting this together. We have a pretty solid group representing different dry bulk companies. Tasos Aslidis is the CFO of Euroseas. We have Hajioannou, who runs Safe Bulkers. Robert Bugbee from the Scorpio Group. Stamatis from Seanergy, and Hamish Norton from Starbulk. You know, it's obviously an interesting time for the dry cargo business, a very difficult time, asset prices coming under a lot of pressure, and you know, as we think about it, I want to throw this first question out, and I asked this 6 months ago at the London Capital Link conference. You know, in this market today, as you look at your companies, are you playing offense or are you playing defense in this type of market? It's a bit of a, we'll see how, it's an interesting question, but I think, maybe we can throw that off to Robert from Scorpio. How would you answer that?
Well, I think right now, up until recently, I would say that we've been squarely standing on the ropes, or just standing on the ropes, with the ropes supporting us, getting the absolute living daylights beating out of us. And so we've been playing very solid defense. But the best way to make that defense is to just keep moving, keep creating events that improve liquidity. Because this isn't, it's interesting, the debate on when the market will recover. But I think that the more important aspect for the dry cargo market at the moment is liquidity. The questions for each of the managements of these companies on this panel, or any management in the dry bulk market right now, is have you got enough cash on the balance sheet to pay your bills? Because in a funny way, we actually want this next year, this next 18 months to be tough. It is most likely to be tough. It is never darkest than at the dawn, and we're seeing a really dark night. The only question really is how long will that night be? It might be a long night. But outside of this, we can see in this market those people who are capable of playing offense really starting to do it. So what's not in this room at the moment is the greatest experience and the greatest balance sheets and the greatest historical success. And those are those private ship owners. Some people refer to them as the billionaires, some people refer to them as the shipping gods. But those shipping gods have been buying dry bulk quite aggressively for the last 2, 3, 4 months. They're private families. They see that vessels at the moment are steeply discounted in the second-hand market to the replacement values in the long curve. They don't make nice calculations on a quarterly or a yearly basis. They look back over 25, 50 years of the history of the dry bulk market and see a very long, strong demand curve that has a few blips, 97, 2001, today. But overall, that curve related to GDP and world population growth has continued to go upwards. And they can buy vessels at a substantial discount to the forward replacement price. But what they have over any of the invested companies or the public companies or most people in this room is they have time. They have time because they're buying in cash. And that, I think, is the greater question. So to me, any move that creates liquidity on the balance sheets of the companies may seem as defensive, but in many ways it's offensive. You're transitioning to this moment you can change your company from a short-dated option on the near-term necessity of a recovery in dry bulk to a long-term investment where you can turn time on your side. You can be closer in the continuum to those shipping gods is a good thing.
And Omar, a point to add to what Robert said, the companies that are playing offense because they had little or no debt and a lot of cash. And it's very difficult to sell to the public markets a company that doesn't have a lot of ships, has little or no debt, and has a lot of cash. But that's the balance sheet you needed to play offense in this market. And maybe means that you should have had some private companies on this panel.
If I can add a comment as well, is that for sure the name of the game is liquidity, increasing your liquidity to survive. At the same time, you can play a little bit of offense. The separation of the values allows you to do asset swaps in a way that taxes your liquidity relatively little. So for a smaller company like ours, that's a way that we see we can play both defense by increasing the liquidity and a little bit of offense by swapping assets of medium age with younger ones for a very small incremental investment.
Yes, I may add as well that nobody knows when the recovery will come, if it's second half this year or second half of next year. What it looks like forming at the moment is a plateau of prices of second-hand ships. I think we won't see them lower than the current levels because of all these people of private families very much interested in buying second-hand ships at the moment. I think banks also are seeing into this positively. I am expecting that current values of last month was the lowest we would see in the foreseeable future. I don't think we would see them lower. The fact that people made money from tanker business as well affords them to make investments in dry bulk. So at least there is one positive sign that we have seen most likely 80–90% chance the bottom of second-hand prices. It won't recover very fast, but it shouldn't go lower than what it is now.
If I may, just to take up what Hamish is saying, and I agree with that. So what I first spoke to was the position of Scorpio Bulkers as the public company. On the private side, we may not be one of the shipping gods or the billionaires, but our private side is no debt, no leverage. It is the model. And that is going into full offense for the dry cargo market. We don't see that there has been a better opportunity to buy dry bulk. And what's great in a well-capitalized, or not well-capitalized, but a company like why do we buy in salt right now, is because we're actually buying the assets in salt at cheaper than what the billionaires are buying in the open market. So we may not have as much money from the private side as them, but from that point, this is the time to go full offensive, when it's the darkest, when the parameters are there, where supply is coming down, when there is restrictions on lending. That's proved in shipping all of the time. You don't buy when there is a surplus of capital coming into the market. You buy when capital is really precious, and it's equity that matters.
And if I may say, well, we at Seanergy, we didn't buy our ships in 2012 or in 2014, so we didn't do exactly what Robert said. We didn't buy expensive ships. We started acquiring our tonnage in 2015, and we will continue to be in a position to be expanding our company. We're a public company. We don't have any private side to have a conflict with the public or anything like that. So we will continue to expand the fleet. And I think that no investor historically, having bought assets at these levels, have ever lost money. On the contrary, they've made hundreds of millions of dollars.
Thank you. Maybe just off of Polis's comments about asset values, do the panelists agree with that type of commentary, that asset values may have bottomed?
I mean, absolutely. They are at the lowest level that I have seen them in my, I guess by now, long time in the industry. I mean, we were always referring to the mid-80s as the absolute bottom that ever observed, and I think this one has surpassed it. I also believe that we have hit the bottom, although, I mean, it's hard to say that that with 100% certainty, but very likely we have hit the bottom, and the prices are very, very attractive for anyone who has any liquidity to pick them up.
And if I also say that a few months ago, like 3 months ago, there was a ship up for sale, and there were 0 inspections. No one was interested in inspecting the ship at all. Nowadays, there is quality tonnage out there. We have a list of about 100 high-quality ships being up for sale, and you have at least 10 people inspecting, like the big names, like the Gogic that were mentioned before. But not only them. We see a lot of people starting to have a very real interest in acquiring tonnage these days, and we see that by the number of people inspecting actually the assets when they're up for sale.
I agree that this is what's going on at the moment. The question is that what you'd like to see is a true confirmation of bottoming, is you'd like to see all those public companies that need to raise equity having their equity issues done. I think we've seen the steps of that. We saw Golden Ocean, we saw others, but there are, most of those public companies up there need further equity. We'd like to see that done because that removes the potential overhang of them selling assets into a market and takes a group of assets away. The other thing we'd like to see is, we'd like to continue to see on the private side, the banks doing the behavior that they're doing at the moment, which is having little tolerance for bad balance sheets and pulling ships away. So yes, I think we'll have this first stage where I agree that a bottom is being put in, but a real technical solid bottom hopefully will occur over the next 2 or 3 months as public companies raise equity and banks go in, take assets away from, for example, private equity controlled vessels or private owners without any equity and restructure them. That I think is needed because you're not going to get the bottom lifted out, confirmed by time charter rates or cash flows.
And of course, we've got to make sure that, we hope that scrap prices, don't drop further and that scrapping capacity is sufficient to scrap the vessels that need to be scrapped. Because, once you get to 15-year-old vessels, maybe even between 10 and 15, those become scrap candidates in this market.
And maybe to that point, there's a lot of question that comes up regarding scrap and demolition. It's been off to a record start so far this year. Is there a limit to what can actually be scrapped from a scrap yard perspective?
Yes, I don't think there is a limit. There is a time factor. I mean, if a ship has to be scrapped, it will be scrapped. It will sit somewhere and wait its turn for the yard and the beach in Alang or elsewhere to accept the readiness of that ship to be scrapped. So the capacity is there. It will take a bit longer in order all those ships to be scrapped. So I think that there will be a rush for scrapping in the Indian subcontinent in the next 3 months before the monsoons kick in. So it's good to monitor this activity. It always reduces during July, August, September because of the strong winds there. But I think the capacity is there, and it's a matter if there are too many ships, which is good to be scrapped, they will wait a little bit longer and they will be scrapped a couple of months later.
Well, if I may provide an update, so far on the Capes, we have seen 41 vessels committed to be scrapped, either scrapped or committed to be scrapped. We're not even in the end of the first quarter of the year, and if the trend continues, we will see more than 140, 150 Capes going out of operations. And I think this is great news because people are expecting zero fleet growth in 2016, but I think ultimately we will all be pleasantly surprised that we'll have negative fleet growth, especially on the Capes.
If I can add another comment, Omar, scrapping is the way the industry manages its capacity. You try to correct to market conditions you don't like, if there's oversupply, and you scrap ships. However, today, we have another way to do that, and we have an excess order book that people don't really want to build anymore. So managing those new building contracts and finding ways with the yards to reduce the outstanding orders, that's another significant way the industry could manage itself.
So the industry is trying to do that regarding the lack of new ordering capacity, but the big elephant in the room is the news over the past few weeks regarding Vale with those monster Vale Max orders. Any comment about the reasoning behind those orders or what the impact will be on the sector going forward?
Yes, Vale tends to disappoint us from time to time. The first lesson 4 or 5 years ago was a disaster. Second one, I have no idea why they make this move, because simply the market shows us that it's always ahead of whatever moves mankind takes. You know, the market is a market, and it corrects itself when there are too many ships built. So I don't see the reason why these ships need to be built. I also don't know the delivery dates of these ships. It has not been properly reported. Is it 2019, 2020? What sort of deliveries? Maybe the panel can help there.
I actually think that Vale are being fairly logical for themselves, as is China on the other side of it. Brazil has very low production costs of iron ore, and a lot of it, but its major competitor, Australia, sits much closer to the major demand center, China, than Brazil does. So if you looked at it that way, Brazil benefits from low costs of transportation. It doesn't have any real reason to make the Cape market better. It's doing something that's pretty logical. It's also helping the Chinese shipyards. Politically, that must be a good thing. Politically, that would be a way to make them a better potential supplier to China. And I think this is, one of the things that, it's not, this Vale order hasn't just come out of the blue. It's been spoken in shipping markets for 6, 12 months. We've known that they've been doing it. One of the reasons that we've concentrated now, we've got rid of all of our capes, is because we think that in this particular recovery, it's going to be led, except from, let's say, the bottom up. This isn't going to be led by the Capesize market itself. We not only have Brazil and China's interests related to low-cost transportation of iron ore, but we also have a situation where they're still continuing to close their steel mines, steel mills. We have a one commodity, a one dependent commodity, and to one geographic country. But what we have seen, for example, in our product tanker business, we've seen great diversity of trade, great diversity of economies that we're going to, where we're seeing underlying demand there. And I think we're seeing the same thing in the dry cargo, that the smaller sizes depend much less on just China being great or iron ore being great. So I don't think Vale are doing something that's that illogical. And we just have to, remember that the job of shipping for the customer is to provide safe, as cheap as possible transportation. And China and Vale are doing a pretty good job at that with these orders.
And if I may add also, we think that the Vale order is kind of overblown. I mean, if you think about it, every year you have 160 to 170 capes on order book at any given time. So the nominal order book in the beginning of the year was 160 capes, right? 20 Valemaxes, which is equivalent of like 40 capes, spread over 2 years between end of 2018 until end of 2020. I don't think it's going to make a real difference. Obviously, the difference is going to happen when more and more people, when and if, well, hopefully when, the market will recover, they will start putting more orders. But the Vale order alone, I don't think it's going to create any problems in the capacity. If you think about it, there's zero order book in 2017, zero order book in 2018. So it's the only ships on order, basically. That's what it is.
And there's never been a dry bulk order that's gotten quite so much publicity as this one. And, the fact of this frightening order may prevent others from ordering when they might have without such an order. So, I agree with Robert on their motivations. And, I don't think, though, that it has a major impact on the market.
Yeah, as long as it stays on its own. If others not follow, I mean, this is what's happening in the liner industry and the container side. I mean, one orders, everybody orders. I don't think this is going to happen on the dry side.
No,
but if it stays on isolated,
I agree, and I agree it's a long time out. So also it's them signaling. You've got a customer and a big supplier saying that around 2018, 2019, they would expect the dynamics to recover, which is why they're trying to defend the cheap transport. But, going back to it, the biggest danger to the dry cargo market right now is that it recovers early, that it shows some false hopes, that you stop scrapping, we have a rise in rates in the next 2, 3, 4 weeks, that capital gets complacent, that companies, private equity firms with big books say, well, you know, we don't have to do anything, we don't have to inject equity, and you get a delay of this important element, which is the stability on the balance sheets to properly take away tonnage for sale, take that overhang away. I mean, it's a little bit like you guys watching your stock market. You really, really have to have a proper consolidated bottom where those people have hung on with no more money to play, are blown out of the water, and new equity is coming in that has time on its side.
Maybe we should have a show of hands. How many private equity investors in the room would bring a dry bulk new building project to their investment committee in the next 5 years? See?
Yeah, I think also the question should be how many private equity guys are hanging on in their companies, preventing their managements from raising equity and doing the right thing right now. How many private equity companies are sitting in front of lenders saying, look, give us an extension, pretend and extend, as opposed to putting up the equity to clear the market. I mean, I really applaud the lenders this time round in their attitude to stop pretending and extending and forcing companies and forcing investors to the table. I really hope that continues.
Thanks, Robert. You know, maybe just, you know, on that note, you know, Hamish, you had mentioned earlier, you know, the sort of the weird confluence of Wall Street looking for, you know, for growth in earnings and growth in an asset base versus the value that shipping is. It's more of a value story. You know, what are the lessons learned from this, and how do you prepare yourselves for the next go round in case dry bulk, after it recovers, whenever that happens, goes to another disaster like we're in today? What can somebody do to be prepared and be ahead of it?
Well, you know, it makes a lot of sense for shipping companies to have very low debt because, you know, maybe I'm getting too technical here, but, you know, the capital asset pricing model says the only benefit of debt is the tax deductibility of that debt. And of course, in shipping, interest is not tax deductible. So there's no real benefit in a public company to have debt if you can avoid it. And so while I think it's very difficult to sell to the public markets a company that has not only no debt but a lot of cash, that might be the ideal balance sheet to play the shipping cycle. You know, the next best would be no debt, and, you know, the next best would be a little bit of debt. You know, I think that is possible.
I think the debt is important, but not the most important factor. I think really the important factor is that the industry has to stay focused on the investment rationale. What the industry did wrong, along with the investors, is that they look for opportunities. It was hard to find them into existing ships and existing projects, and the easy deal for all this outside money was to go and order new ships. So the industry, who traditionally overshoots in the booms with excess ordering, overdid it this time around. It went excess of the excess, and that's what has created this order book that is very hard to absorb. We had cycles many times in the past. Shipping is characterized by cycles which are created by the over-ordering, but this time was really an outlier because of all this money that came to the industry looking for a deal. What was the easiest deal? Order a ship.
I just don't think the industry is ever going to learn. You know, most people in the industry are passionate. Most people who invest in the industry are passionate. You know, the derivation of the word passion comes a lot with pain. And we're destined to, it's been going on like this for hundreds of years. The next time rates are way up there, you know, they're turning great returns on things, then there's going to be pressure from the shareholders to return capital, to do X, Y, and Z, and the industry will just continue. It's just the same as the wishes of consolidation and things. It will be the same. We will create extraordinary gains and profits for those that invest at the right time, and there will be extraordinary losses for those that don't.
You know, with the outlook so bleak, does anybody have anybody see any positives on the horizon? Any bright spots? Obviously, Robert, you said near term you don't want to see any, but is there anything that we can point to that would point to a dry market turnaround?
Yeah, the world economy, the people are being born every day, and the world generally is, hopefully, is going to be at peace, and there's a lot of stimulation from lenders, and is a lot of the correct long-term building blocks of capital keepers in there that are going in. People who, you believe it or not, you're getting interest from value funds, from value mutual funds, going alongside that real deep pockets of private real money. These are true building blocks for the future. They're just hopefully isn't much good that the spot markets are going to do for the next 12, 18 months.
And a wall with Mexico is going to take a lot of scrap steel.
And something else, sorry. The industry is not going to be obsolete anytime soon. Cities will continue to be built, the roads will continue to be built, and infrastructural projects will always continue. So, and of course, at the end of the day, the population needs to be fed. So, this is a real industry. We carry hundreds of millions of tons, billions of tons of cargo every year. And at the end of the day, it will have to continue. So all the new capital coming into shipping right now, I don't think they should be diverted into existing projects for, the 60 or the 70 or the 55 million Cape projects to break even. I think now it's the time for someone to invest in companies that have the position to acquire cheaper tonnage. So, you can buy the same ship that you paid $55 million last year, you can buy it for 30 today. And this is the real opportunity, and this is where the new capital in shipping should be going.
The other part you haven't talked about yet is that there's different. One thing that's different here is that, a lot of this reminds me of the 1980s, the viciousness of the market, the worries of the world economy, the same situation in crude oil with OPEC trying to regain their share, et cetera, et cetera. But what is really different for shipping in this, and I call in general for shipping, because at the end of the day, dry cargo does sit in the group of shipping, is yard capacity. Between 1986 and 1990, you had a tremendous growth in yard capacity going on. The Koreans didn't really exist as major shipbuilders coming into 1984 and 1985, and they left 1990 with tremendous capacity, tremendously efficient yards. What's happening right now, and it's hard for you guys to see, but the shipyards across the world are in great stress. There is a genuine chance here that we could get some rationalization in shipyard capacity, in not just the major Korean yards, but with the Chinese government saying that they really don't see it a necessary requirement to support their own yards going forward, that we could see some of that capacity come down. And then you really create a real lift for the whole of shipping in 2 or 3 years' time.
Alice?
Yes, I think the most positive thing we see right now is that for the last 2 years we have not seen any ordering, and this is expected to continue for another 2 years, except the recent Vale order, of course. I think this is the most important thing. Supply will not increase. One day demand will do a 5% or a 4%. It was quite normal in the previous years after Lehman Brothers to see growth of 7, 6% or things like that. We never know what the world need will be in a certain part of the world or how the Chinese will decide to spend their reserves. I think that the most optimistic message comes from the order book. So we have to be patient. We have to make sure that we are there when the recovery starts. And good companies and good managements will have to do whatever is needed for their companies to be around in 1 year, in 2 years, in 3 years, whenever this recovery comes.
I think Paul is absolutely right. I think there might be a little bit of bright spot through the overcorrection of the industry. We might overdo it on the other way by canceling too many orders and sort of scrapping too many ships, and that could create, maybe, hopefully not in the very near term, so some pain is felt on the marginal players, but could create a bright spot at least for the sort of medium term.
I mean, 3 years ago we were sitting in this room and dry bulk panel was very optimistic. People ordering ships and spending money. We did some mistakes as well. We ordered a couple of ships more than we should have done. On the other hand, I was skeptical at the time. Should I do it? Should I not? Everybody else was doing tens of ships. I finally decided instead of doing 3 or 4 ships to do 5 or 6. And I remember in the other panel I attended, the tanker panel, they were all crying and saying that it's finished, it's done, no more crude, it's all gas and things like that. Nobody knows how the world will develop and how all these parameters of commodity prices, oil prices, all these things, how they are going to move. The positive thing is, the only positive thing I see, and it's for fact, is that there is 2 years of no ordering, and another 2 years, simply because there are no money, there will not be any orders for the next 2 years as well.
I agree with Paul. So 4 years ago, we sat here and remember that great phrase. The crude oil and tanker market is going into an abyss that it will never get out of. That was what this conference was 4 years ago, Nicholas. This was the headline across all of the press. Exactly. Yeah. This was the headline.
And everyone was convinced.
And convinced. And today, I wake up this morning, Monday morning, and hey, I'm happy to put my money down on the dry bulk market. I'm happy to put it down in a way that I haven't done ever right now. And that's because the right people, money is buying. The lenders are putting constraints on vessels. The shipyards are under issue. The private equity is leaving the market. Major analysts have just downgraded the entire space finally into a position. Analysts have been saying, we've been waiting to do this, we should have done this, have now finally hit the bottom of this market. It really can't look much darker right now from a capital side. No one has yet said it's going into the abyss. They don't need to. They're saying it's over, they're done. They're already dead before they fall into the abyss. And that to me is the right time to take a look at the dry cargo market.
But no new buildings. No new buildings.
There's enough dry cargo ships to buy, right? You don't need new buildings. But let's get the clear out. Get the guys who need to raise equity, raise that equity. Get those balance sheets cleaned up. Take those sellers away.
Okay, thank you everyone. Looking forward to seeing how the March 2017 Capital Link panel goes. All right, thank you. No, it's very important. It's grown to a very, very big conference. You get the leaders from all over the world of all the different companies across the different sectors within shipping coming together, and it creates good networking opportunities, but more so gives us a feel for what's going on in the industry and what to expect going forward. Well, I thought it was very important, with dry bulk, it's probably the most topical sector in shipping right now. It's going, through the doldrums, things are terrible, but there are some strong underpinnings that are showing a recovery, not necessarily in rates today, but you've got the big ship owners, independent ship owners, private equity, or private ship owners themselves are putting capital to work. The bottom seems to be in. Equity investors are out, private equity investors are out. You have banks that have given up, shipyards are giving up.
right now is probably the right time, if you have the capital, to go in and invest. Countries, well, Athens is a great place. It's the hub of shipping. Greece definitely has interesting opportunities.
I want to congratulate Nicholas and Capital Link of organizing the 10th Capital Link, which is a very informative forum of meeting shipping people and investors in New York. Over the years, he has provided for us great support and putting all these people together. It's very efficient to how we promote our company. He's our investment relations manager. He's a person I know for the last 10 years. His integrity is unparalleled. His effort, and a self-made person. We should all congratulate him for his success. We hope we continue to cooperate with him for the next 10 years. We are at the low part of dry bulk cycle. We all know it's a very difficult market. We think that we have seen the worst for prices of ships. I think we have seen the bottom in last month, in February. The recovery will be a slow process. People should not be fooled and rush to buy assets. We have to see more signs that the recovery is coming, maybe take another 9 or 12 months or even more, 18 months. But you know, good shipping companies will survive and will be here to work the good years when they will come.
Very glad to be part of the 10th Capital Link annual conference. I want to congratulate Nick Bornozis for putting this conference together for the last so many years. It provides to companies like us an outlet for reaching the US private equity, regular investors, bankers, and the entire shipping community of the US, and also brings us closer to our colleagues from all over the world who come and present here. We are very proud of sponsoring the conference, and we hope that we'll be able to continue being part of it for the years to come. Nick Bornozis has been able to put together a series of magnificent events for shipping, for Greece, for other parts of the investment public, and he has given this type of opportunity to many companies and investors to come together, and we think that he can provide significant service not only to shipping but in general to companies that look to access the capital markets in the United States.